You're about to learn some of the most innovative investing strategies, but not only that, you're also going to hear about the most creative agent commission strategies that I don't actually hear anybody talking about. And lastly, we're going to be unpacking and unbunking one of the biggest myths when it comes to investing in multi-residential properties, which most people think and assume that you need millions to get into it. But we're going to walk you through some incredible scenarios that prove that this couldn't be further from the truth and give you the roadmap on how to start investing for yourself and help your clients do the same. So today is my pleasure and honor to bring you Mark Ferris from Canada, who moved to Florida. Mark, not only that, he still runs one of the most successful teams in Ontario, Canada, closing over 1,000 transactions annually, but he's been absolutely crushing it with his multifamily investment projects, with his unique approach and his creative strategies that anybody can start doing when it comes to growing your real estate portfolio. He will be breaking down for you his entire blueprint on how to double your equity investing in real estate in a super tangible way that you'll be able to implement by the end of this video. Let's dive in.
Guys, for showing up here. We are so 9:15. So from a timing standpoint for you, we're going to go to this presentation. This is going to be a little bit more casual. So it's more going to be off the cuff. There's going to be a Q&A at the end, so there'll be a chance for you guys to ask questions. The presentation won't go past 10. So if you have another appointment, we'll get at least the content done. The Q&A may go past 10. So I'd say like max 10:15 will be out. And really the goal from this is to give you guys something of value that you can leave with. So Andrea had mentioned, whether you are looking to invest yourself, looking to have another offering for your clients, right? So another real estate deal, whether you're looking to invest yourself, or if you're just looking for, we'll just say, further insight on how multifamily works and why I was like totally fell in love with this asset class. Okay. So to backtrack a little bit, I started real estate in 2007, and I got into real estate because I thought, what better way to learn about real estate investing than to become an agent? I picked up this book, Robert Kiyosaki's book, Rich Dad, Poor Dad. If you haven't read it, it totally changes your mindset, and it did for me. And so that's why I jumped in. First 6 months, early struggle. We maxed out our credit cards. That's kind of the early struggle phase that we all went through. And after that first 6 months, we scaled our team up. We went from 38 sales to 100 sales to 160. We transitioned up to 1,000 sales. And at that point, I was selling 150 homes a year while leading the team doing 1,000. And I realized we were hitting the ceiling year over year of 1,000 sales. So it was very clear to me that I needed to transition out of selling into the CEO role and to learn the answer to two questions. What are the barriers to growth? And also the other problem was, what is a CEO's role in a company? Like, what's the scorecard look like? I didn't know, right? I was leading and I had an overall idea, but it didn't really condense it down. So I transitioned out of selling into the CEO role. And then finally, after about 2 to 3 years of implementing the right processes and systems, we hit 1,400 sales. We cracked through. We did 1,013, 1,400, 1,700 sales. And 2021, we did 1.4 billion in sales volume. So learned a lot and had to pivot a few times along the way. Now, 3 years ago, what happened was I was buying real estate all the way along. So I was buying single family properties. Many of you probably did that as well, where you could buy a property, say in Barrie or Hamilton, and they would cash flow a couple $100, which were great investments. You would have clients coming to you and you would sell them these properties, just as I did. And then we started buying our office buildings. Because, when you speak to business owners, generally they'll say the best thing was the building that they bought. It was more valuable than the business. So I took their advice and started buying our buildings. And then we started buying the smaller multifamily, 6, 10, 14 unit deals in around the Simcoe County region. And they were great until about 3 years ago. Everything got so expensive. And the problem there was that deals stopped cash flowing. And so many of you probably know what I'm talking about here. The other problem was I found it was harder and harder to navigate the landlord tenant board because, you know, if say a tenant stops paying in Ontario, now you actually need to take 18 months sometimes to get them out. And so it can totally wreck your returns. So it became a higher risk profile and it was harder to find deals. And so during that period, I had built a strong leadership team and management team. We transitioned at that point. I realized that I could run the team through online where I come back every quarter and in person that way. And when I went down to Florida, I realized that it reminded me a lot of 2008, 2009 when I was looking at real estate deals. And all along, we worked with thousands of investors. We couldn't sell them anything because it was harder to find great deals. And it was a high risk profile, remember? So I started looking at deals down in Florida and was like, oh my goodness, 2008, 2009 flashback. This is amazing. Deals cash flow from day one still. And there's no rent control, meaning that if a tenant stops paying here, within 1 to 2 months, we can have them out. Not only that, if they sign a 1-year lease and let's just say they're $300 below market rent, at the end of that 1-year lease, you can raise it to market rent. So no rent control. And so what that does is when you buy these multifamily deals, you can buy them under market, and over a period of 1 to 2 years, you can slowly raise the rents. And that's what I'm going to be talking to you today about, how multifamily works and how these properties are valued. So I think you're going to learn a lot from this. This is where I fell in love with multifamily investing, because the alternative was the single family deals. Like, you guys know what I'm talking about here. Trying to find great deals now, you got to be very creative. You need to buy a corner lot and sever it and put 3, properties in, right? So this was an alternative there that I thought that there was a huge palette that I saw from our own clients and for me personally. Okay, so first off, when you guys are late at night and also your clients are late at night, generally there's financial concerns that keep us up late at night, right? So, that's a big one. Will I have enough money down the road? Like, this is something that for me, my biggest thing is I want to work because I want to, not because I have to. Like, that to me is like the ultimate. Is like, I don't ever think I'm going to retire, but these are concerns that are going in most people's minds. No matter how much financial you have, you're still thinking of these things, right? And so this is why, with those concerns that are keeping us up late at night, what's the we'll say vehicle to help us get there? And real estate, I'm not going to get too far into this because you guys should be investing in real estate as real estate agents already. Okay, so I'm going to skip this, but here's just a few reasons why it is such a great vehicle to create wealth. And what's really interesting is that there's always an emerging market somewhere in North America. There's always an emerging market somewhere, as in there's always a really good place to invest before it hits. And I didn't realize this before. It didn't click. But when you start looking outside of your area, you start finding these locations. Now, the one thing I'm going to say, because when you look at this list, it's all pretty straightforward for you. The one thing, downside protection with Big Three, you may have a question on that. So what is that? There's 3 things that you can do in real estate, okay, if you want to protect your clients or protect yourself. If you do these 3 things, it's very, very difficult to ever get hurt on a real estate deal. Number 1, if you buy a deal that cash flows from day one, okay, it's making money. That's a hard way to lose if it's making money from day one. That's why flips are so easy to lose money, because you don't have any income coming in. So buy a deal that cash flow. Number 2, adequate cash reserves at the property level. So if you have a buffer there, it'll be some, we'll say, cushion for you in case something goes wrong, okay? And last but not least, we've all seen this, fix your debt. So fix your mortgage rates. If you do that, it's very difficult. We'll just say it's very, very difficult if that's the case. And that's why a lot of operators got hurt, because they violated one of those 3 rules, okay? And we saw that with a lot of the speculation in the condo market. That's why people are get hurt. So if you follow those 3 rules, if you put that in your pocket and you talk to your clients about that, you're serving them really well because it sets them up. Now, the problem is that where do you find cash flowing deals, Mark? And that's what kind of led me down the path. So there's big five, and you guys know these: cash flow, mortgage pay down, tax incentives. You can depreciate these properties, natural appreciation, and last but not least, forced appreciation. And this is where I'm going to talk about the main bulk of this presentation, is in the forced appreciation here and how it can be predictable value add and wealth creation here. Okay. So why don't more people invest? I mean, you guys know this, you've heard it from clients. They're not sure how to start. You know, they don't have time. They're busy. It's overwhelming. They don't want tenant headaches. Most people have a story or know somebody that has a story, right? And so this is where, if real estate is the bridge to get you across, we know there's reasons why people don't do it, especially now. It's hard to find great deals. We really wanted to come in and build a vertical to support that, where you as the investor could get all the upside in these deals and not have any sort of cap like a lot of these REITs, but to provide that, we'll say, support to the real estate bridge to get you across the other side. So why apartment buildings? First off, when I say safer investment, the reason this is the case is when you're in a recessionary market, if you buy B-class assets, and that's what we buy, we don't buy the brand new turnkey ready deals. We buy something in a very good area that is, say, on average charging about $1,600 to $1,700 once we do the renovations. Because in a recessionary market, people move from $2,500 apartments to $1,700. Okay. And so this is such a beautiful asset class right then and there. Not only that, we buy deals that have a value add component. So they're making money. They're like 90, 95% occupied. They're making money from day one, but we validated that they have a certain lift per month in rents that we can force value in these deals. And because there's no rent control, we can slowly flip the building while we're cash flowing it. So it's a safer investment than if you just buy, say, one property and flip it. And there's more, we'll say, buffer in there compared to buying, say, an A-class property that's already done up. Okay, so it's safer that way, especially in a recessionary market. Lower vacancy risk. If you buy 100 units, so you partner up, you buy a bigger asset, right? If one or two are bad tenants and they're not paying, you don't even really feel it. So there's lower vacancy risk. Apartments, these value add deals we'll just say they're more rare and they're increasing in demand. There's economies of scale. If you have 100 units renovating, you get lower costs. I mean, and the predictable value add, and that's what I'm going to show you the equation here and the formula that made me like such an advocate of this. And then there's just a bigger opportunity to help more people. You can help 100 families if you can elevate the community and the culture. It's a pretty cool thing. And I'll talk about one of the most recent events that we did that was pretty cool to see. So first off, if you haven't seen this, this is something that's really important that all of our clients are currently going through, right? The reality is that home ownership has become a lot more expensive than renting. And so we're all in the business here in selling homes. And I am a huge advocate that you need to buy your own home, because the stats say that if you own your own home, your net worth is over 200,000, I believe 210,000 as a homeowner, compared to a renter being $6,200. So it's like, yes, own your home. So important. The next question is, if real estate is the best place to, say, park, then what do you do as a secondary investment, and where do you park that? And that's where I'm talking about. I still think that what we're doing here is hugely valuable, and we help people build wealth here, and it should be in Ontario, wherever they live and work. It's just that secondary property is what I'm referring to. So the reason I'm sharing this with you is we are becoming more of a renter nation. It will be harder. I tell people, like, what do you think is going to happen in the future? I can say with like a huge bet that in 10 years from now, everything's going to be more expensive than it is today. And like that, if you want to debate on that, then I'll debate anybody, and I'm betting millions of dollars on that right now. That's the facts. And so if that is the case, then you want to make sure that you are diving into an area that is growing. So real estate value is growing, But also, if you're buying something with residents in the renting side, you're buying a business when you're buying an apartment where there's more, we'll say, prospects or leads that are getting into that, that's going to make your asset more valuable, right? So you're buying into a trend here versus like a dying trend when you're buying these properties. You're buying a business, essentially, is what you're doing. And then when you're looking at the alternative, say the stock market, for example, you don't have these big ups and downs. So if you look at net operating income growth, and then that dotted line is consumer price index, and we all see that happening with the cost of goods going up, right? Everything is more expensive. The problem with the S&P 500 or say stocks is that there's huge ups and downs. I'm not a huge fan of waking up one day and having, 30, 40% of my portfolio wiped out and then say, oh, that's just normal, give me more money. It's like you've lost 30% of the portfolio, right? And so I get the approach of doing it along the way, and eventually it will come back. But I like sleeping better at night, and I'm not a huge fan of these ups and downs. Now, the other thing here is that you want to get into a trend where everything is becoming more valuable. So if you're wondering why we're at a huge shortage in Canada and the US, and so when I got my head wrapped around this, it made more sense to me why we're at a shortage here. And so the reality is in 2005 compared to 2023, so this is US data, but it's the same story in Canada, okay, that there are 38% less housing starts or permits issued compared to 2005, okay, in 2023. Why is that the case? Well, in 2008, there's a huge housing, we'll say, collapse, right? It was horrible. Subprime mortgages. I mean, Canada, we were more protected here, but a lot of developers got wiped out. And so these developers didn't build for a while. They either got wiped out or they were slow to get started. So they got behind, right? Population growth continues to happen. 2021, supply chain issues. I was in the middle of building a 10,000 square foot office building, and my cost went up like crazy. Most developers just put their projects on hold. So they got behind again. And then 2023, you had interest rates double. And so you have a lot of developers, we're talking with them and they're saying, you know what, I'm just gonna hold. My housing material costs have not gone down at any substantial level. Their labor has gone down a bit, but the reality is that they're just saying, if I'm not getting my price, I'm just gonna build. These guys have billions of dollars to wait, right? And so the reality here is that housing is becoming more of there's more demand for it. Okay. So this is, if you're speaking with clients, that should be a little valued nugget. Here's why we're behind. Okay. It shows that you're the expert. Okay. So we want to be able to invest in an area that's growing. So then when I said earlier about emerging markets, there's always an emerging market somewhere. What creates an emerging market? And the first thing that we look at here is affordability. And so what do I mean by that? Well, in Jacksonville, for example, you can make $99,000, so half, and have the same lifestyle as somebody living in San Francisco. Okay. So like housing is a huge part of that. Okay. Housing costs. So on average, we will buy an area if the average income is say 100,000, after we're done the renovation, it needs to be 35,000 or 35% or less. We won't buy in an area after we do the reno if it's higher than that. Barrie, for example, is 50% of the average income is going towards rent. Toronto is 60%, and New York is 70% of the average income is going towards rent. We wouldn't be buying in these unaffordable areas. You want to buy where it's affordable, and eventually it will become unaffordable. So you're buying before market hits. Okay, so we look at that. We look at affordability. We look at the leadership and if they're offering tax incentives, if they want growth. And so that's why you have huge employers moving to these affordable areas, because they can pay their employees half, and they can have the same lifestyle as somebody like, that's why they're moving away from San Francisco, New York. They're moving to these affordable areas. And so these bring jobs creates population growth, right? People move into the area, and these people need places to live. So that's what creates a housing boom, right? And so that was really big when we started assessing what creates an emerging market. Those are the key factors there, okay? So we have another presentation where we talk about our 10 steps on how we actually go and acquire these buildings, but I'm just going to give you like the dessert. It's my favorite part of the presentation because I know you guys are like, hey, Mark, give me the goods here. Give me the goods. I'm busy. I got my appointment. Stop rambling. Just give me it. Give me it quick. So here it is. So this is the one part, this value-added approach, this one formula that I'm about to share with you guys. If you really wrap your head around it on how it can create wealth, it was a game changer for me. And if you can get your head wrapped around it, I think it'll be a game changer for you as well. So I just did this quick copy and paste on this image here. But if you're not, like, you guys would have learned it when you took your commercial course on how income approach works. Okay. So anything over 4 units, commercial, these properties are not valued based on direct comparison. They're based on the income approach. And the income approach really comes down to this formula of net operating income. So net operating income is you take your overall rents in a building, okay, all of your income, if you generate any sort of like washer, dryer income, any income coming in, okay? And then you have your expenses. So maintenance, insurance, taxes, right? Property management. Then you have your net operating income. Your net operating income sits above your mortgage payment, okay? So that means that for every dollar that you increase your income or decrease your expenses, not including your mortgage, your goal is to increase the net operating income as high as possible. So that's your net operating income. Now a cap rate is, it's a capitalization rate. So it's like, what do properties trade at? And the net operating income is, the cap rate is a percentage of the value of the building. So say if the value of the building is, say, $1 million and your net operating income is 50,000, well, that's a 5 cap. Okay. It's 5%. Okay. So that's, if you take the net operating income divided by the cap rate, that spits out the value. That's how these properties are assessed. Okay. So anything 4 units above, if you're doing a deal, this is what investors are going to look at. Okay. The cool thing about this, you only need 2 of the 3 numbers to work out the third. So if you know what the market cap rate is and the client wants a certain cap or a certain value, well, it should spit out that's net operating income in the building. Otherwise, their value is too high and you got to bring it down. So now, based on this, what does this mean, this formula? This means that based on a 5 cap, that for every dollar that you increase the net operating income per month, okay, it increases the value of the building by $240. Okay. That means that if I can go into a building and see that there's $100 lift in rents for 1 unit, I know that I can increase the overall value of the building by $24,000. Okay. And this is the main kind of meat that and so just play with me here for a little bit, like play along here. So if you have $1, okay, $1 per month, okay, you pull out your calculator. If you're driving, don't pull it out. Your $1 per month, okay, an increase times 12, so that's 12 months. That's $12, right? Now, if you divide that, so that's your $12 of extra net operating income per year. If you divide that by the, say, a 5 capper, that properties are trading at a 5 cap. You divide that by 0.05, that equals $240 in value. Okay, this is like it's pretty, like, once you get your head wrapped around the formula, it's pretty straightforward and simple. This is how banks assess these properties. And so the really cool thing is based on that, if it's $100 for 1 unit that you can increase the rents or find some sort of extra income. Okay, if you have 100 units, think of what that turns into for value creation and wealth creation. So I'm going to share with you an example. Okay, so just for purposes, $1 per month in net operating income equals $240 in value creation. Okay, so let's take this 300 unit multifamily deal. Okay, 300 units, you're buying it for $38 million. I know you would never be able to do that in Toronto, but in some of these southern markets, you can. You bring in $19 million in equity, and this includes all of your renovations, all of your closing costs, everything, okay? 19 million. So I'm going to show you, based on this equation, how you can double your equity without any sort of natural appreciation. So you're not even banking on the market going up. But we all know in 5 years from now, the market's probably going to be higher, right? Okay, so let's play this out. So we went in and we looked at this property. There's a good deal. Broker emails us and we say, and we go in and we say, okay, there's 200 units that are classic units, so they're not renovated. Okay, there's 100 units that are already renovated that are getting $150 extra per month. Plus, we walked through all the comparable apartments and we validated, yes, market is paying an extra $150 per month for a renovated unit. Okay, so we're like, okay, we're going to go and renovate 200 units. We're going to say do 10 units a month, and we're going to slowly flip the building over a period of 2 years. Okay, if we do that, we know that $150 per month, based on the local cap rate of say 5%, works out to $36,000 of increase per unit, or the 200 units, $7.2 million in value creation in this deal. Okay, let's keep going because we're stacking this now. We also validated that 250 units are $100 below market rent. They call it loss to lease. Okay, so we know we can get another $100 in addition to the 150 on the renos. So just based on that, we bring it up to market value over that period of say 2-year business plan. We can increase the building by $6 million. Washer and dryer hookups, 200 units have hookups, but the ownership, they're just, we'll just say they're not on the ball and they didn't install washer and dryers there and they're not charging $50 a month. We go in and see that as an opportunity. We're like, okay, part of our equity that we raise at the beginning, we're going to buy washer and dryers. We're going to charge $50 a month. That increases the value of each unit by $12,000 or $2.4 million in overall value. Fenced yards. I have a little dog, Bella. It took my family 3 years to convince me to get a dog because I know what they do. You guys know as agents, they come and they slobber on you. You just got your suit dry cleaned. And I love dogs. I just saw what they did to homes. Finally, I give in and we go and get Bella, and I saw her. And anyways, I love Bella now. Okay, but I'm a huge fan. Little miniature schnauzer. If I was a resident in a building on ground floor, and if the ownership came to me, say, listen, we're looking to add some value to you. We're looking to add a fenced in yard where you can have your own private yard. Okay. You don't have to pay anything for it up front, but it'll be another $125 a month. So you can just kind of pay along the way. Is this something you're interested in? You better believe that I'm going to say a resounding yes to have Bella go and run around, just open the door and she's running around all happy. Like, so we've identified in this 300 unit complex that 50 units are on ground floor that are conducive for us to offer this. So just based on that, we've created $1.5 million in that idea on executing that. Okay. Parcel lockers, $9 a month extra for the 300 units, 648,000. Valet trash, we put this at you can hire a company. We get another $20 per month by taking the garbage away. And so we bring the up at their apartment, like a trash bin there. They put it, they don't need to walk down the community trash bin. We charge $20 a month, $1.44 million. So let's stack it up now. What does this mean? So you got the renos, increase in rents, washer, dryer, fanciers, lockers, trash, boom, 19 million in value creation. This is no natural appreciation. I'll let that sit with you for a second. This is where I was like, oh my goodness, it's that predictable. And I'm like, oh man, I see why now all of these wealthy family offices, they're all buying these apartment buildings. It's like, of course, this makes sense. You're cash flowing it from day one. You're adding value to it. They're inflating the dollar away, but rents go up. You're in a market that there's no rent control, so you can increase it. And it's like, oh my goodness. And Canadians, we're in an area where we can't find cash flow deals and we have rent control. And it's like, okay, well, Let's build a vertical and really help Canadians do it in a tax efficient way. So that's what brings us to this particular deal. So it's like, okay, Mark, that's a make-believe deal, even though that happens regularly. The 104 units here, this is an actual deal where we have a few spots. We just closed over the last 6 months, we raised 23 million US dollars to close on 144 units in Charleston, South Carolina, and 104 units in Tampa. So we've closed on this deal, but we have a few spots left. Andrea had reached out and I said, well, we do have a few spots left, so we'll open it up to you guys here. But just super high level, I just want to quickly take you through this particular deal here. So first, why Florida from a location standpoint? So everything that I went over with you about affordability and location, Florida, there's a lot of people moving there. Okay, we'll just leave it. There's no rent control. And just so for the record, there's no state income tax. So that means that whoever is working there keeps more money in their pocket. And so, for example, I was getting my hair cut down here in Florida, and the hairdresser, hairstylist, dresser, she's telling me, she came down from Rhode Island. She said, Mark, if I moved down here 10 years earlier, I would have been completely retired by now. She's like, I don't pay any state income tax. They pay 7% sales tax. We pay 13 on all services, right? And just they're paying better down here, and so they're looking. So this is why people are moving down to these areas. There's more affordability, and it's like Florida is the 18th largest economy in the world. If it was its own country, it's over $1 trillion in GDP. It's huge. There's like over 23 million people down. It's big, and so not only that is very diverse and from an economy standpoint. This is one of the reasons why I didn't invest over in Alberta, even though I think you can still do well there. It's very reliant on oil. I like more diversification in the employment, so that if one industry takes a hit, then it's not going to wipe out my tenant base, right? And so that's where we really like that diversity. That's our branding, and that's what our new monument sign looks like on the left-hand side there. So we brand all of our properties. We go in, we increase the culture level by, we have a mission statement, our core values in each of the communities, and then we rebrand it here. So this particular deal, it's actually in Largo, so it's 20 minutes from the Tampa Airport, International Airport, 20 minutes from Clearwater Beach, 20 minutes from St. Pete's. If you want to go watch a Bucks Rays or Tampa Bay Lightning game, it's all within 20 minutes of this location. Based on that equation that I went over with you, $324 per month lift. That's the upside in the 104 units. So based on that alone, based on this cap rate that I just shared with you, that formula, we're forcing value by $8 million in this project. Okay, we bought it at $168,000 a unit, so well below replacement cost. You can't rebuild for this cost. And we waited over a period of about 8 months where we didn't get a deal because we saw pricing came down. So we got this at a significant discount as well. And we're assuming a first mortgage of 4.83% interest only. So the beauty of that, we're not paying the 7-8% rates that they're charging for commercial down there now. Projected returns on this, because it's predictable based on the net operating income, that's how we establish these returns. So the 18.5% annual return. Not only that, so you get 5.5% distributions, which are actually starting this week. So it's monthly that come out. And this is all return of capital. So you're not paying tax on that until we sell at the end. And then when we sell, it's a capital gain. So it's a huge, we'll say, opportunity to keep more in your pocket. And we do this all, like, we have a cross-border account, and everything we do is above board, but we're efficient in how we structure these distributions. And so pretty much 1.93 equity multiplier, and the term is 2 to 5 years. We are looking to sell after we do the business plan after 2 years. The challenge is we don't know what the market will be in 2.5 years, but our goal is to sell it as soon as possible once we do the flip, because majority of the value is gained in the reno. So once you're done the reno, then you're just getting cash flow and natural appreciation. We'd rather sell it and then have another value add deal, force appreciation in that next deal. So we'll get you higher returns if we can do 2 flips in 5 years versus 1 flip in 5 years. So that's why we like selling and then going to the next project. And then this is not for everyone. We do have 100,000 US minimum in our deals. First class service is really big. All of our investors have my direct number. And actually almost half of our investors are agents, funny enough. You know, they're seeing the same challenges as what I was just talking about. And so just being an accredited investor as well. So that's just, it's a financial kind of checkbox. So you either make 200,000 in income or $1 million in investable assets. So super high level. If you're wondering, okay, what'd you purchase that? So 17.5 million, all in costs for reno and closing and everything, 3.8. So we're 21.4 all in. Total equity on this, it's actually 10.5 is what we're raising. We actually came down a little bit in the equity raise. And the overall acreage on this 7.6 acres. So it's a big plot of land. We don't buy anything with HOA fees or anywhere near a floodplain or anything. And we're looking to project to sell with 10 million in increase here. So if you invest in 100,000, you can see here's how the distributions work year over year. And then, you know, we have some other top producers that have come into our past deals that, you know, are super happy. Tom from Ottawa, Mary from Guelph are in our deals. Amy here loves to see those distributions. And then Patricia and Chris Guernsey there from Belleville. So we have some other top producers that are in that are loving what it is that we do. So on that, I'm going to open this up to questions. I think I did pretty good here, Andrea, to get through, so I'm not holding everybody up. So if anybody has a 10 o'clock stop, you'll get some questions in. If you do have more questions here, there's two options. Number one is just to find out more on the deal. There's a landing page that we can send you guys on that QR code on the left. Shreesi, if you could put that in the link below, so if somebody is watching on their phone, they can click on it. You can fill that out. We'll send you the actual landing page. You can go on my Instagram, Mark Ferris, as well. And if you click in the link tree there as well, you can actually see the landing page where there's the webinar and the business plan as well. If you have more questions, book a one-on-one call with myself. And that's a quick 20-minute call. Even if you're not quite ready now and you think maybe a year from now, better to have the conversation to understand it so you can kind of work your way to this. On that note, we have only a few spots left as well. So once it's filled, these deals, they're filled and you got to wait for the next one. And this one is actually already our first year projections. We're ahead of schedule on this. So it's such a great time because your returns will actually start from when we closed on this. This is the end of March. So your distributions will go back from that closing date coming in on this deal right now. And as an agent, this is the two things again. As an agent, we're actually offering this as another offering for you or your clients. So 2.5% is what you guys will actually get on this, anything that you invest in the deal. So whether it's yourself personally, because you guys, if you go buy an investment property, you get a 2.5% discount, right? On the co-op fee, maybe they're offering 2, but you get that. So we really want to position this as another offering for you that you could sell, whether it's you buy it personally or you have a client. You may want to invest first and, you know, see how you like it. And then from there, you can, you know, refer to recommend it to your clients. But again, we have about half of our investors approximately are agents right now because they love not only the deal, but also they have the opportunity to get that 2.5% that we're paying back to you guys. So on that note, I'm going to open this up to questions, and then Shreesi, if you could put those links for the
if anybody has any questions, please put your electronic hand up. In the meantime, until you think about it, I have a question. Okay, we all know that investing is the right thing. Now, the question that I have for you, why investing in multi-units rather than going and buying a solo home that you basically, you're banking on the increase in market and not appreciation in market?
Yeah, so single family versus multifamily. Well, you know, a number of reasons there. First is the fact that to find a single family cash flowing deal, remember the 3 golden rules: cash flow, adequate cash reserves, and fixed debt. Well, you're having to drive up to like Sudbury now. I mean, I don't want to go to Sudbury. I used to be able to buy them in Midland and Aurelia, so a tertiary market. So Barrie stopped cash flowing, and that was unfortunate. And then Aurelia and Midland, and then it's like you got to go to Sudbury, and then Kirkland Lake. Like, I don't want to go to Kirkland Lake. I still want appreciation as well. And that's why if you buy, say, in like an area like Tampa, you better believe that there's still appreciation play there, big appreciation play. And so I want both. I want cash flow and appreciation. So the problem with single family right now is you have to feed the deal. And that to me is I've seen a lot of operators get hurt that way. And it's okay if you have like a one property, you're feeding the deal, but from an investment standpoint, you're hoping and praying that the market goes up for natural appreciation. And so cash flow is just a really great place to be. And I saw how important. I used to invest on appreciation, just by the way. So I'm not like this always cash flow. I saw it over the last 3 years, how important it is to protect yourself. Because if you're just investing based on appreciation, we saw like you guys have a lot of clients probably that bought and they got hurt. So that's like a big one. I mean, vacancy risk right now, it goes down substantially. You can flip these buildings while you're cash flowing them. So with a single family, like, can you imagine going to a tenant and say, I'd like to renovate while you're living there. You got to pay me enough to cash flow. And once I'm done the reno, now you're going to pay new market rent. Like that would never happen. Right. So this is where down here, that's what we're doing. We maintain 95% occupancy. So what we do is these leases are coming due all through the year. So as they're coming due, we offer them a premium unit, or we offer them to pay new market rent, which is still okay. We might get them on the following year, right? So every year we're offering that premium unit. And so we're slowly flipping them. So that 5% stays the same. And so we're cash flowing and we're flipping it. So you can't do that with single family. And rent control is a big one. And that's why, flipping over the market is a big one we're investing. So
we have Michelle with the question, but before I take Michelle, quick question. What are the chances that Florida will implement rent control as well?
Any of the red states, there need to be like a fundamental shift in thinking. Like, they're so hardcore business down here. It's always a possibility and risk. It was just for me, especially Florida and like Texas, they're pretty hardcore on like freedom and like very landlord, business. Like they celebrate business owners. If somebody does really well, they celebrate because they know, because business owners, and you create jobs. Any of you that, if you have an assistant, you doing well is very good because you're providing a job to somebody. And so that's just the overall mentality of that. So it's just, it is a possibility. It's not a probability in my opinion.
Got it. Michelle, what's your question?
Yeah, quick question. You showed all your charts with the numbers. Are those all US?
US dollars. Yeah.
US dollars. So when you say 100,000, you mean 100,000 US?
Correct.
So it's going to be like 140 Canadian. Okay.
Yeah, I think 137 right now, but yeah, pretty.
Okay.
Yeah, I'm splitting hairs though.
Okay.
Yeah, 100%. Yeah.
And one other question. So Florida, I know I've heard about Florida being really good for multi. And I'm a big proponent for investing outside of Canada, because exactly what you said, it's very hard to cash flow. Myself, we do the Caribbean, right? And
Love that.
yeah.
Love that.
Yeah, but so Florida, is that the number one, would you say, place to go?
So great question. We like Florida, we like South Carolina, we like North Carolina, we like Georgia.
Atlanta?
We like these markets that are generally the red states, and the reason for that is like no rent control, low tax. People are moving there, businesses are moving there. Like you want to buy as people are starting to move in. And so we look at like all these different, I went over some high level numbers that we look at before actually buying in. So the amount of research we do before actually purchasing, is like very in depth. And we have a full-time team of 9 now. So we went and recruited the best acquisitions guy that we could find that has over $1 billion in acquisitions, that already have relationships with brokers. Same with the asset manager. She has 20 years experience going full cycle on like countless deals like this. So the research goes deep, and that's why. So Tampa and Charleston, those are 2 favorite markets right now, to summarize your question.
So what do you do after you sell? You can cash your money out, or you can reinvest it moving forward in your next project?
Yeah, so once we sell, so the beauty there, it's a capital gain. So just remember that. That's like a big win. It's in US dollars that goes back to you. And our goal is to have another value add project that you can say, oh my goodness, like great returns. Let's do it again, Mark. So the beauty with this is you get to see the deal and say, I like that deal. I'm going to redeploy my capital back in. Once you see how these deals work, and you really get your head wrapped around, you'll realize that your returns that you can get in these deals, because what I'm advertising here, the numbers are coming in even better than that, but we're conservative. Because we structured the deal as a partnership, you actually can get better returns investing in these deals with us than, say, going and doing it on your own. That was one of my biggest things. I'm like, I want to build it in a way that I would want to invest. Otherwise, I'll just do it on my own. Okay. And so that's where these returns are strong enough to be able to do that. And you're not having to spend any of your time doing it. Okay. We got a full-time team of 9. Like, I'm not personally, like, these guys that have been doing it for 10 years, these guys are like ninjas they're at the whole other level. But one of my strengths is building a team and vertically integrate how we operate with discipline and doing it for specific reasons for Canadians investing in these deals. So that's how we're able to get a competitive advantage on these deals. There's 3 things basically we do. Deal flow. These are like 1 in 200. They're very rare deals, especially now. The second one is property management and making sure we're under our rental cost projections. So we're managing it. We're building culture in these projects, managing on a day-to-day, so it doesn't take any of your time. And then the cross-border taxes and legal. We look after everything. So at the end of the year, you're not having to pay a bunch of accounting fees and, getting double tax returns and all the rest of it. So,
Yosef, you have a question?
Yes, so great presentation, by the way, Mark. Now, what is the capital gain fees or rate there in Florida? And also, do we have any kind of management fee once we sell this? Like, what are we looking in terms of management fee, whatever fee? Is there any other extra fee involved once the whole project is sold?
Okay, so the overall, okay, so the fee, and then your first question was the capital gains. That was the other one. Okay, so the 18.5% returns are net of fees, net of all everything. Okay, so that's what, if you get less than 18.5%, then we failed. Okay, like it's to you. Return of capital, so you're keeping those 5.5% distributions on average in your pocket, and then you sell. The capital gain, now they just, by the way, guys, this on the 21st or 23rd, this new capital gain that they're talking about, increasing it from 50% to 2/3, that is based on, they're saying that, so just remember, for personal, it's still 50-50 up to 250, and then it's 2/3 after that. But if it's corporate, it's from the beginning. Okay, so if you own a property in a holdco or corp, then it's from the beginning. But they haven't actually written that into code yet, so just that may not happen still. Okay, so there's a lot of pushback. It probably will, but just it's not a for sure thing yet. Okay, but if that's the case, if you invest in our deals personally, it's up to 250. You still be paying 50%. So, sorry, 50% of the gain. So say we take your 100,000, we bring it to 200,000, that 100,000 gain, only half of it is taxed to your regular, your income tax level. So say you invest personally, you got 100,000 in capital gain, 50,000 of it is going to be taxed at your regular income level. And let's say you're paying 50% tax because you guys are top producers. You're paying 25,000 in tax, right? So half of the 50,000 is going to be taxed there. So because we structure this super efficient as a Canadian limited partnership, all of our Canadians invest in that Canadian limited partnership. And then all those proportionate shares flow down to a Delaware limited partnership that owns the property. We have a full-time CPA that looks after all this for you. Like, you don't even need to worry about it. If you talk to your accountant, you tell them two things. You're going to invest into a Canadian limited partnership. Okay. That's the first thing. And it's return of capital. And it's a capital gain when we sell. And so you're going to get a Canadian tax slip, or they call it a T5013. Don't worry about that. The letters there, Canada likes to be a little bit more confusing. In the States, they call it a K1. It's like, just call it something simple, T5013. Anyways, so that's it. Hopefully that was, and in regards to like the structure on all this as well, like we offer an 8% preferred return. Okay, so you get the first 8% of all the cash flow, and then after that, it splits to a 70-30. Okay, and so that works out to about 2/3 of our overall upside is in that 30% bucket. So it holds us accountable, okay, during the project. And then so we do have on the purchase, there's an acquisition fee, and then there's an equity management, and then one on the back end. So it goes 3, 1, and 1 on a percentage basis. But we can jump on a call on that if you want to go deeper on that. Just understand that 18.5% is net of fees, and the 5.5% is paid on a monthly basis. That's divided up over 12 months. We pay that out monthly.
Got it. Thanks. And one more question. Now, for investors, we're not looking at the credit report and credit score because they're investing in a pool. Is that
so
accurate?
Really good question. This is a big. So we signed between these two deals, just so you guys are aware, we had over $1 million in hard money down in US dollars. So I cut a check and I was like, here you go. And if we don't close on it, I lose it. So we personally sign on these deals as well on part of like Ferris Capital Partners. Our limited partners, all of our investors, they're limited partners, as in they have limited liability. So there's no liability if we were to be sued. Okay. The only thing is the money that you put in. That's what you're bringing to the table from a partnership standpoint. Okay. We look after everything else. So you don't have to, be qualified other than the accredited investor status as well. But outside of that, we sign on the loan. You don't have any sort of the downside on that end. Good questions, Yusuf. Yeah. Thanks for jumping on.
Jump on a call with Mark. Super available. I made that call. I'm happy I did it. So just jump on a call. It's easier to explain. There's a lot of, or for me, there's a lot of numbers, a lot of new terms that I'm not familiar to, and then you kind of get all over the place. So it's the best to just jump on the call.
Yeah, and Andrew, there's two things here that you guys might be wondering. Number one, like whenever you're looking to invest or go into anything, it's like, number one, can I trust them? That is, I don't know. Can I trust? And then are they going to be able to deliver what they say? Are they competent enough? Like, that's probably what you're probably thinking that, right? And I was like, can I trust this guy? And is he competent? Well, competency standpoint. So my partner, John McCarowitz, so he was the CEO and president of Mark Spain Real Estate. Now they're the largest real estate team in the US. So he is like, they sold their company for, we'll just say, a big, massive check, and they're an actual team. So there is just for the record, there's hope if you have a team that you eventually might be able to sell it. That was the only team that I know that has sold to a private equity firm. He was the integrator or president. And so when they were bought, he transitioned and partnered up with me. And from there, I'm more of a visionary. He's the integrator. We went in, the team we have will go toe to toe with anyone. So we'll just say the stamp on these deals, when we present them to you, we're extremely confident on the delivery. And then the trust side, I mean, I just look at, I mean, we do about $1 billion in sales volume a year for our team. We got 2,200 5-star reviews. It's like, I'm not hiding anywhere. It's like, you know, and it took us a bit to, it took me a lot to get my head wrapped around making sure that if we're going to offer this to other agents, we need to be able to deliver, because one hand affects the other hand on this. And so that's where I would just give you guys, you know, on those 2 questions. And once you come in the deal, you'll see how we run them. They're really tight. And I think you're going to really like it.
One more question before we let you go that was in the chat. Any idea if the weather conditions and insurance will affect projects like that?
So when the hurricane hit, and I was down here for that, the larger one, that was, insurance did go up during that time frame for a while. Not a while, I'd say for a short window. And then but through that period, we just factored that increase in insurance into our pro forma. So we have a really good insurance broker. And so those costs now have come down considerably on this. So we just factor that in. And so the reality is that one hurricane was like 1 in 60 years. They're very rare. We don't buy anything in a flood zone. Okay, so we make sure we buy only 80s or newer. We don't buy anything in the 70s, because then you get into like galvanized piping and aluminum wiring. We just don't buy there. So we buy the newer buildings. So it's better on insurance. And, you know, so for overall, we just factored that the insurance in, and we're very conservative on that. So I know you hear on the news, like, oh, insurance is, you can't get insurance. That's not true. We can, and we do, and we have insurance. I wouldn't be buying this large of a project without backup if there was like a tornado or hurricane or fire or whatever. So we protect our asset. The bank requires it, actually. You can imagine they wouldn't be lending 70% of the value in the deal here if they didn't feel that their asset was protected, right? So something to think about.
Another question in the chat, the last one, we want to be mindful of your time. Have you closed one of these transactions in buildings to be sold already?
Yeah, so being that we started this about a year and a half, Ferris Capital, the team, when I go back to like the full-time team of 9, we have team members that have gone full cycle 20, 30 times from start to finish. So that's why we brought that expertise in. We've closed on 4 deals. We're looking for a 5th currently. And so the value add, the 3 value add projects, one was a hotel, the multifamily, which we're still going through renos on that. It was more of a fire bullet before a cannon. We did that. And then the second deal we did was a value add deal. That was in Venice, Florida. And then, so we're hitting our projections on the value add deals, because that's the one thing we can really measure. So all the distributions, we never missed that. And the Tampa and Charleston were actually well ahead. And so we're taking these projects from start to finish. The first 2, we partnered with another group down there. So full cycle on this, we're looking within 2 years to sell. But that's where, you know, that's part of it, getting in early, right? You're seeing and able to, you know, get in right now versus waiting, say, a couple of years on this, and, you know, taking advantage of that upside in the deal as well. What we're doing is not anything new. These projects these groups, they've been doing these for decades, okay, down in the US, but I haven't found a group that's offering US deals to Canadians that are running it like we're running it. And so that's where the newness has come from, is not the deal or how we're getting returns. It's how we're offering it to Canadians is what we're really looking to bring to the marketplace.
Well, thank you so much for being here, Mark. And for everybody that has any questions, please reach out to Mark. He will jump on the call with you and explain more. And we'll definitely have you back. I think there's a couple of things that I would like to go back a little bit more to the basics of understanding investment in terms of almost like educating on terms. I think there's a lot of misconception, but also a lot of lack of education and around this. And I would like to be more educated on this. So I would like to have you back if that's something you've been interested in.
That's a perfect attribute of a top producer, Andrea. It's like, I want to learn more, curiosity, right? So, and that says a lot about you guys coming on here as well. You like learning and developing. That's like, you want to be a top producer. That's like table stakes, and you guys have that. So,
I
appreciate
find
you guys
that
a lot.
sometimes we know how to go a single family, just go submit an offer, that's it, you get it back, and you know what you're banking on, you can hold it, you can earn, you can whatever it is, flipping. But I think when it comes to investing and investing in multi-units, there's a lot of unknown that makes people not to make a move. And there's opportunities out there, and I would like to know more about it. And I'll be honest with you, when you hear it for the first time, as an agent, you try to wrap your head around it, to go to your client and say, hey, let me explain you something, an opportunity that you don't need that $1 million. You just need 140,000 and you can make this return. I wouldn't be able to explain it to my clients as of right now. So I would like to be able to take advantage for myself, but be able to be so knowledgeable to teach it to someone, to explain it to someone. So I would definitely want to have you back.
Yeah, 100%, Andrea. It was great meeting you again, and the group setting, seeing you again. We've already hung out, so not so much meeting, but seeing you and the group here. So book a one-on-one call, guys. There's a few spots left, and even if you want to chat real estate, no problem. And then we'll talk to you guys soon.
And we'll have you back for team building, that's for sure.
Team building, yeah, for 100%, I'll be there.
I want to know your secrets. Okay, talk soon. Thank you so much, guys. Thank you. Bye-bye.